Hey everybody, hope this finds you doing well. Today we're going to talk about the FOMC meeting that was just earlier this past week and the effect that it's had on the cryptocurrency market and equities market overall. First, as usual, let's go ahead and start with the cryptocurrency market. As you can see, Bitcoin is basically flat from where it was 7 days ago. It's currently trading at $26,467. Ethereum is down a little over 2% in that $1,500 range, trading at $1,588. And then as we continue to go down in the top 10, we have Dogecoin. It is about flat from what it was 7 days ago. It's still in that 6 cent range. We have Cardano at 24 cents. It's down 1% over the last week. And Solana is up a tad, nearly 3% at $19.44. And then we have Ton, which was a new entry into the top 10 last week. It is falling down a little bit over the last 7 days, and it is currently trading at $2.23. So Bitcoin earlier this week had actually gotten up to close to 27.5 earlier this week, but given the FOMC meeting, now that we know there's a possibility there could be another rate hike before the end of the year, and we could have these higher interest rates for a longer period of time. Some were speculating that there was a possibility that we would have a cut of the interest rates at the end of 2023, but it looks like that's not going to happen. We're actually probably going to have at least one more rate hike and potentially not have cuts until later on in 2024, if not at all. So that's definitely a possibility. So the markets have been showing a little bit of a downside since that meeting earlier in the week, and Bitcoin as well as equities came down. So as we can see here, the federal funds effective rate, this is a chart that goes all the way back to 1955. Currently, we are in that 5.25 to 5.5 range, and this is the highest that it's been since 2007, just before the financial crisis. So it's been several years, basically 16 years, since we've had rates this high. Now we can see that after the financial crisis that the rates went down tremendously, and then leading up to the pandemic it was starting to go back up again, and then after the pandemic it went down again, and then we started to see high inflation after the money printing that happened in 2020 and 2021, and now the Federal Reserve has been increasing rates at a record rate really since 2022. So we had a meeting earlier this week, and the Federal Reserve Chair Jerome Powell has announced that there's a possibility that there could be another rate hike in 2023. Many were speculating that there was a possibility that they could actually start cutting the rates, but it looks like they're going to keep it at this higher interest rate level, and there's a possibility they could hike it at least one more time, potentially 25 to 50 basis points before the end of the year. They also intimated that there's a possibility that these rates could stay at this range for a while into 2024 and potentially all of 2024. So there definitely was some reaction in the markets due to that announcement. And if we go here, the interest rate obviously affects anytime you're trying to lend and borrow money. So it affects a lot of businesses as well in their ability to be able to use cash to add to their businesses and making investments. So that's another reason why the stock market has been seeing a little bit of a downturn, is particularly in tech plays, because they're known to be able to take funds and put them towards investing. And as high growth companies, they need to have that cash to be able to continue to develop their company as they try to have higher growth rates. And if we see here, we're looking at the 30-year fixed rate mortgage average in the United States, and it generally goes in line with the federal interest rate. And as you can see here, we're at the above 7% right now for a 30-year fixed rate mortgage. So this is the highest that it has been since, it looks like, the early 2000s. So we're definitely really getting up there in interest rates. So we are going to probably see more of an effect on the real estate market. A lot of times it lags behind some of the other markets like equities and cryptocurrencies and some commodities, but there is a possibility that we'll start to see some more downside in the real estate market as these interest rates continue to rise. So definitely going to keep an eye out on that. And as we mentioned, we've definitely seen a bit of a drop since the announcement. The announcement was on September 20th, and you can see here with the S&P 500, which is the major indices that tracks the top 500 companies traded on the US stock exchange. And you can see here that it had a dip after the announcement going into September 21st, and it's still continuing to go down. Generally, September tends to be a down month just overall on average, but definitely this past week's announcement from the FOMC, excuse me, has had an effect on the overall equity markets. And another thing that we need to be considerate of is the inverted yield curve. And if you go here to Investopedia, the inverted yield curve shows that long-term interest rates are less than short-term interest rates. So when we look at an investment like a bond, where people take out bonds giving money to the US Treasury, the US Treasury will then yield a certain return depending on the length of the bond. So as you can see here, the yield curve graphically represents yields on similar bonds across a variety of maturities. And an inverted yield curve occurs when short-term debt instruments have higher yields than long-term instruments of the same credit risk profile. So the longer out you go, you have lower rates and you have higher rates the shorter term that you have. So this inverted yield curve is considered unusual. It reflects bond investors' expectations for a decline in longer term interest rates typically associated with recessions. Market participants and economists use a variety of yield spreads as a proxy for the yield curve. So you can see here, this is considered the inverted yield curve. As the maturity goes further out, and you see that the yield is actually lessening. The longer that you go out in maturity, then that is considered a inverted yield curve. So definitely something that you can look up and research a little bit more here on Investopedia, as well as obviously other resources that are out there regarding the inverted yield curve and some of the indicators of a potential recession. So this is definitely something as investors, particularly, that you want to make sure that you stay on top of, looking at the macroeconomic environment, because anything could cause a downturn. As we saw earlier this week, the cryptocurrency market as well as the equity market did have some effects due to the FOMC meeting regarding interest rate hikes. So as you can see here on the New York Times, the Fed aims for a soft landing with a rate pause and a pledge to move carefully. So right now we are steady at that 5.25 to 5.5% that I mentioned earlier. And you can see these were recessions that, when you look at what happened to the interest rates when they were climbing higher, and we then found that soon after there were recessions. So you can see here indicated by these shaded blue lines. So the last one was in that 2008 to 2010 range during that financial crisis. So we are yet to see whether or not we will run into another recession given these higher interest rates. And this is the highest, as I mentioned, since 2007. So Jerome Powell says that we're taking advantage of the fact that we have moved quickly to move a little more carefully now, because their main goal is to continue to get that inflation rate down as they say the target is around 2%. Currently, it is around 3.7% since the last CPI reading. So they didn't feel the need to hike up interest rates anymore, at least at this particular meeting, but it is not off the table that they could do it at some point before the end of 2023. So you definitely want to make sure that you stay posted. These are some of the latest projections now as to how high the rates could potentially go. And it looks like there are some projections that it may get upwards of 6% or higher. We're at that 5.5% range now. So time will tell what will happen before the end of the year and going into 2024. So if we do continue to have these higher rates in 2024 and along throughout the entire year, then we shall see what the markets are going to respond with, whether or not we're going to see more of a volatile market where we just kind of chop around in a particular range, or do we continue to come back down? So it's definitely a possibility, and it's not off the table that we can go back into more of a bear market, because we have yet to return to the highs of 2021 when we think about the overall market, especially in cryptocurrency as well as the S&P 500. So definitely want to stay posted on that. And just one quick news story in the cryptocurrency market before we get out of here. Citibank, which is one of the largest banks in the United States, is developing a new digital asset for institutional clients that is going to be used for cash management and trade finance. So this is going to be a part of the tokenization of financial instruments used by institutional clients as well as retail down the line, but they're obviously considering their institutional clients at the moment, and the service will use blockchain and smart contract technologies to deliver digital asset solutions for these institutional clients. They've already had a pilot program where they have been using smart contracts with regards to logistics. They were working with Maersk, which is one of the largest trading companies in the world, and they work in maritime. And so they have done that very successfully. As you can see here, they worked with Maersk and a canal authority to digitize a solution that serves the same purpose as bank guarantees and letters of credit in the trade finance ecosystem. The pilot demonstrated programmable transfer of tokenized deposits that provided instant payments to several providers via smart contracts. Ryan Rugg, global head of digital assets at Citi Treasury and Trade Solutions, said that Citi Token Services provides corporate treasurers with a new tool to manage global liquidity on a just-in-time programmable basis. Frictions related to cutoff times and gaps in the service window will be reduced. Our solutions within the Citi network are complemented by inclusive and open industry collaboration on initiatives like the Regulatory Liability Network. We are excited about both the potential for shared ledger technology to update Citi services and broader financial system in partnership with regulators and industry peers. So this is definitely something that we will be keeping an eye on as we see that larger financial institutions are looking for ways on how they can leverage the blockchain technology. That's why we believe it is something to keep an eye on as an emerging market. So stay tuned here at Networkchain. We appreciate you watching. In the meantime, take care, and we look forward to connecting with you and linking up with you on the Networkchain very soon. Bye-bye.